Here's your stock market review for today. What I wanted to do is break down sort of a look at what's happening in the future here. Next week, we have two economic data pieces that could seriously derail the stock market. We're about to hit S&P 500 5,000. That's a huge milestone, but a lot of pundits are getting a bit nervous. The economic data that I'm looking at could easily derail, and we could see a meltdown in the stock market. But we don't know for sure yet. This is unfolding. In the meantime, this stock market review, I'm going to break down a few other aspects of the stock market so you have a better idea as to what to be looking for and how the stock market is performing. Let's jump in. The S&P 500 looks accident prone. I've seen a few of these articles and you just sort of look at them, you're like, well, but what would actually push things to happen where the S&P 500 could sell off? Keep in mind, we were at 4,100 right around the third week of October when the bond yields were pushing as high as they did, then all of a sudden reversed, and the S&P 500 took off nearly 900 points in a very short period of time. This is a huge move upward. All things that go up must come down, some could easily argue. A lot of traders are getting nervous at these levels. But what does the economy tell us? These are the things that really kind of drive the way I look at the stock market. And there are two economic pieces of data coming out next week that could easily derail this. And I believe that there is an opportunity that we could see the S&P 500 coming off of its peak, if but for just a moment. Inflation is likely to not surprise on the downside. That at the very least we see a consistent pace, if not a move higher in inflation, the rate of growth or the rate of increase for the year. The second thing, retail sales. We're going to see retail sales next week, and that could be another strong report, and this could easily make everyone a little more nervous about the future. The economy is performing well. Jobs, we're at 3.66% unemployment rate. That is beyond what we used to call full employment. Given all that, there could easily be price pressures, which could derail the S&P 500. Let's take a look. What I do, I take the S&P 500, one share of each stock, the NASDAQ, one share of each of the 100 there, and I ask the question, the next 4 quarters, add those together, divide over the current price, what is yield? S&P 500 has fallen below 5%. The S&P 500 in my index and the NASDAQ are not weighted. It's just one share per stock. But it gives you an idea as to where things are. NASDAQ at 3.387%. You have the opportunity to invest in the US 10-year Treasury yield, which is about 4.125% right now, versus the NASDAQ at 3.387%. That should be a red flag for a lot of people, that your alternatives, a very safe investment as far as risk goes, versus the NASDAQ, where's the downside if we do see things moving lower? Now, what if interest rates move upward? Yes, if interest rates move upward, then what you bought has eroded in value. But if interest rates move up as well, NASDAQ would fall sharply, even though NASDAQ isn't necessarily really driven by interest rates per se. Then there's 11 sectors within the S&P 500. And again, one share for each. It's not weighted. I use the Spider Select Sector ETFs, and they're all broken down here. Of course, XLK stock, technology ETF, 3.067%. You have better investment opportunities with the US 10-year Treasury yield. Some of these stocks being driven in the NASDAQ and technology are overpriced. And let's take a look at the Magnificent Seven. These stocks here, Apple stock, Amazon stock, Alphabet stock, Meta Platform stock, Microsoft, Nvidia, and Tesla. You can see the yield given today's the future 4 quarters over today's price. 3.214% is the total, which you could invest in the US 10-year Treasury yield at 4.125. But take a look at Alphabet and Meta Platforms. The US 10-year Treasury underperforms that. There's still a lot of upside with Meta Platforms and Alphabet stock. Google, GOOG is the symbol. So some are overpriced, others are not. So this Magnificent 7 still coming in at 3.21%. Here's a look. Now I put this chart together, and if you kind of look all the way over on the left-hand side, this is the S&P 500 index. That was, I think, October 23rd when we saw that low right at that point. And since then, we're at 49.95 to close today. It might not have closed exactly that when I pulled this off. The S&P 500 keeps going. So it gives you an idea as to how quickly things have moved upward in the S&P 500 index. We are so close to, we're 1/10% away from 5,000. More than likely, we breach it this week. Will we stay above there? Tuesday and Thursday are the days that I'm looking at. And let's take a look at core inflation and personal expenditures. All right. Core inflation in the red versus personal expenditures in the blue. If you take a close look at this chart, you'll see that the red inflation, there's a bit of a delay. So as we see the rate of growth of expenditures for consumers shifting upward or downward, you see sort of a lag in inflation. Given that, take a look on the right-hand side, you can see how core personal expenditures are starting to move upward. So even though we're seeing core inflation moving downward on a year-over-year basis, rate of growth, expenditures are starting to move upward. We've seen the previous two retail sales, 0.6%, 0.6%, 2 times in a row, month-over-month gains. If expenditures continue to move upward, which it's still at a moderate level, this isn't really necessarily the high point for personal expenditures, it could easily keep inflation elevated where we don't get to the 2% target rate in a quick period of time. That's the key that I look at. We'll still probably get there. The Federal Reserve might have to raise interest rates a little more, maybe a quarter point, maybe a half a point, given the breadth and the strength of this economy, until they get to 2%. But if they hold the interest rates at where they are, eventually we'll probably get there. But what happens in the meantime, if expenditures start to move upward, this could push price pressures higher. Retail sales, this is both core headline retail sales and ex-auto and gas. And as you can see, things are starting to tick back upward again. If we get another month-over-month increase for the coming month, which we get retail sales on Thursday, inflation report was on Tuesday, this could be what rocks the stock market off of its lofty prices. But that's Tuesday and Thursday. In the meantime, the stock market probably will breach 5,000. Here's something I wanted to take a look at, the US 10-year Treasury bond. For myself, I do not see the yield moving lower. And what I trade normally versus the US 10-year Treasury yield, I trade the TLT stock, which is the 20-plus ETF for Treasuries. And I'm likely to sell calls on that and also buy puts like I did just a couple days ago, last week, going into the non-farm payrolls number on Friday. I'm probably going to repeat that going in on either Friday or Monday of this week with an expiration of next week. I'm a very short-term player when it comes to moves like this. I'm expecting the stock market to take a look at those two data points, inflation on Tuesday and retail sales on Thursday. And I expect that at the very least, we don't see any movement in interest rates, that the economy moving forward as it is keeps things where they are. The 10-year yield doesn't change. So my calls would at the very least expire worthless. But if we see a hot number, then my puts go in the money. That's how I trade these kinds of things. We've got your at the money prices, and what I'm going to do is I'm going to kind of maybe on TLT stock move out about $3 on the calls and $3 on the puts from the at the money numbers. Here's a look at the VIX, pushing lower and lower. If we see any kind of movement lower in the stock market, it will probably be very sudden, and the VIX will likely shoot higher. As it turns out right now, participants are not concerned about any kind of downside whatsoever. I thought this was very important, and I wanted to include this in the stock market review today, because with the VIX moving as low as it is, pushing back down close to maybe 12, if we do see any kind of movement downward in the stock market, the VIX will pop upward, which means puts their value will appreciate rapidly. That's something that I play for on a regular basis. I look for Vega where it might be at a low level, Vega meaning volatility, and with the VIX you can see that there's not much volatility whatsoever. No one's betting to the downside. Keep this one thing in mind. Warren Buffett, not sure if you heard of him. One of the things he preaches often: be greedy when others are fearful, be fearful when others are greedy. We're about to hit S&P 5,000. Not many people sound like they're fearful. That's an interesting thing to be considering right at this time. If you like the stock market review today, make sure to hit that like and follow button. I try to put it out as often as relevant, usually a couple times per week. Hit the like and follow button. We'll see you in the next video.